And we have been watching, of course, the market for special purpose acquisition corps continue to be of huge focus and attention. That is true right across the whole private equity space. Record flows of capital and record valuations on deals. Brenda Rainey is with us now from Bain & Company's global private equity practice. Brenda, thank you for being with us. And it was those numbers I really wanted you to key into before we get to that conversation about SPACs, which is when you see there's a ton of, as you put it, dry powder out there, lots of potential money to flow to deals. That's got valuations at levels where it feels as though you don't want to make a mistake. There's not a lot of room for error here. Characterize this market for us. Have you seen it before?
Absolutely. There's been a tremendous amount of dry powder in the industry for a long time. It continues to build up. It now stands at about $3 trillion, and that's capital waiting in the wings to be put to work. Wow. And that is absolutely fueling competition for deals and pushing prices very high.
Yeah, you know, I have been going to the super return conferences here in Berlin for the last few years, and that number keeps getting higher. How much money is out there that needs to be put to work in private equity? One comment I thought was really interesting, I just heard it a couple days ago, although apparently it's from a 2016 paper, is that SPACs are the poor man's private equity. It gives retail investors a chance to get into a PE-like investment without being considered sophisticated, plunking down $1 million and so forth. Do you think that's a fair characterization?
Well, absolutely. Anybody can invest in a SPAC. It is open to retail investors. So there is a bit of democratization of private equity that happens with a SPAC. SPACs have been huge. We saw over $80 billion raised in 2020, another $25 billion raised just in January. So we see no end to this trend. I think the big question for private equity investors, is this opportunity or is this a threat? And it's probably both. On the opportunity side, for any private equity firm that's looking to exit a company to the public markets, SPACs offer a fast track to an IPO, and SPACs can be a friend. On the threat side, they are also competition for deal flow. Oftentimes, SPACs have 24 months to find a company to merge with. So they are at times competing for the same deal flow as traditional private equity funds.
Your own research found that SPACs underperform. They've underperformed the broad market from 2016 to 2020. So how do you explain the massive continued popularity when the numbers don't back up the inflows?
Historically, it's certainly a mixed bag. We did see about 60% of SPACs that were raised in 2015 to 2019 underperform the S&P 500. And I think we'll continue to see some winners and some losers in the mix. The one thing that's very important is that once the capital has been raised, the real hard work begins. It's up to these SPACs to find a company to merge with and to take public. So deal sourcing is incredibly important, as well as very great diligence on any company that they're looking to take to the public markets. Not all companies make sense to be public companies. SPACs need to look for companies that have the stability of earnings and revenues and a growth profile and a runway for value creation that the public markets will value.